Good day to one and all. This is Dr. Sivaraman of iknowindices.com. I'll be giving the twin webinar, which I give once a month. Call it as tracking the forex market together. So you and me are going to track the market during this European session and try to find out how exactly we can take trading decisions. So I will tell you what are the inputs required for tracking the market. Then we will try to find out how exactly we can quickly take a decision and enter into the market. And by end of the session, we'll be able to close the position with a profit. So today we are on 18th of August. Between 8 and 8:45, I will explain the simple live market tracking technique and also the effective trading strategy to earn consistently from the river market. So the only tool we use is the live market code page. In the live market code page, you come across the majors here displayed and the bid and the ask, then high and low from the start of the Japanese session. Then here you come across the net change. If you see the net change here, Euro, GBP and Australian Euro and GBP are showing positive net change, and USDN and USDCHF are showing negative net change. That means they are making the USD weakening move. Whereas the commodity pairs, USD CAD is showing positive net change, Australian dollar is showing negative net change, indicating USD gaining move. So they are making the contrarian move. Why they are making the contrarian move now during the early part of the European session? So the European session starts from that of 7:30 GMT. Now we are by 8 GMT, 30 minutes past the start of the European session. Why the market is just holding? And if you look into the top of the events which are going to influence the market today on 18th of August, if you look into the calendars, there is a data release, CPI, Consumer Price Index, by 8:30 GMT. So we are by 8 GMT. So obviously the market is waiting for the Consumer Price Index to be released, and then they will try to make the quick moves in the market. So whenever there is a data release, then what happens? The market waits. So what are the components we use for taking the trading decisions? First of all, the derived forecast. That is, using a statistical algorithm, I derive the market forecast for the entire week and I give it during the Asian session live market analysis on every Monday. So this is the slide I had shown it yesterday, that is Monday, 17th of August. What are the session-wise moves in this week from 17th to 21st? So with the help of the algorithm, I'm in a position to give you the market timing and also how exactly the market is expected to behave. And today is 18th of August. The market is expected to make a small rise after that of the Japanese session close, by that of the Japanese session close. And later on, they are expected to make the swing and slide move. So a swing on the upside, and then after the data release, they are expected to make the slide. This is what the forecast says. Then we require the forecast. So when the market is going to slide, that is Euro and GBP, we are expected to slide. It is better to go in for a sell and buy trade. That is what we grossly derive. Then we go to that of the market reading. The market reading technique, we note down the initial lows and the highs on a daily basis around 3:30 GMT in 4 majors and 2 commodity pairs. So here you come across the code page. Here you find the high and the low set for the day. And later on, they just breach the high and go above, or breach the low and go below, and increase the spread between the high and the low. Here you come across the time frame. You have to add 4 hours to this because it's a New York time. If you add 4 hours, that will be GMT time. So it is 8:05 GMT. At the current moment, the market euro is showing about 12 pips positive net change. GBP is showing about 4 pips positive net change. So we know that 8:30 GMT, in another 24 minutes, there's going to be a data release, CPI data release from UK. So for that, the players are expected to make a small firm up and then slide. That is what the derived forecast says. So the derived forecast, they will swing near the high and then make the slide. We know how this high is. How these are all the highs for today. So we should take sell position near those highs. And what are the chances of a stop and above that? Then also we use the trading strategy. Why we need to use the trading strategy? Even though we have the derived forecast and also we have the market reading, that I will be doing it now for you, comparing the current market level with it of the initial lows and the highs, what they are set around 3:30 GMT. And then, okay, here are the initial lows and the highs. We'll compare it with it of the current market level. See, euro, they just came down to that of the 1.1072. The initial low came down to 1.1052, and then gone above that of the initial high 1.1082, and then went up to 1.1094. Okay, it's only a nominal spread. So normally we take positions when the spread increases to more than 40 pips. Only then, if we commit position, we'll be in a position to book profit quickly. Otherwise, they will be simply holding the market and it might test our patience. Then in the case of GBP, 55.76 is the low. They came down by about 14 pips to 55.62 and then gone above that of the initial low and breached the initial high 55.91 and went up to 55.97 and come down. Then, so in the case of euro, they just breached the initial high and staying above. Whereas in the case of GBP, they went above that of the initial high and come down. Then in the case of yen, 124.38 is the low. They just breached the low and staying below that of the low for 30 minutes from the start of the European session. So they are likely to come down in the case of USD yen. The high was 124.50. They just breached it by 2 pips. They made their upward stop and for 2 pips started coming down. So it is likely to come down during this session. Then in the case of USD CHF, 97.80 is the low, 97.94 is the high. They just breached the low and came down to 97.56 and holding below. That means they wanted to make a slide in the case of the USD CHF also, because 30 minutes they are holding below that of the initial low. That means they will make further downward move. And the high is 97.94. They just breached it by 2 pips and come below. So they wanted to make the slide in the case of CH. That is how we read the intentions of the players. Then in the case of Canadian dollar, 1.3079 is the low that is not being breached. 1.31303 is the initial high. They just breached 1.3127 and staying above that of 1.3103 for 30 minutes in order to make a rise in the case of USD CAD. Australian dollar, 73.44 is the current level. 73.64 is the low. They just breached the low and staying below that of the initial low for more than 30 minutes. And the high is 73.86. They have not breached it. So what we come across now? You come across a mixed reaction in the market. Euro breached the initial low, came down and breached the initial high and staying above that of the initial high for more than 30 minutes. That means we expect Euro to go up. So what we'll do, we will just keep a buy limit order just 10 pips below that of the market. 1.1088 is the current level. 82 is the initial high. So we will just put it as 83 and keep the hedge order. That will be a sell stop 30 pips below 1.1053. Then we will try to exit with 45 pips or 75 pips limit order. I will put the limit later. In the case of GBP, as I told you that they intend to make the slide. So they reached the initial high, 91.55.91, and come down, and they are close to that of 55.90.91. So we will take straight away a position. $1.5590 with a buy stop. $1.5620, 30 pips above that of the market. We keep the buy stop, the hedge order. In the MT4 platform, they are all called as the buy stops and the sell stops. Then in the case of yen, I was telling you they breached the initial low and staying below that. So we'll try to take a sell position, 124.23. With the hedge order, $30 pips above. Then in the case of CHF, we are not supposed to take positions in all currencies, but I'm just showing you how exactly such entries can be made. So if you take in position in all currencies, then it may lead to over trading unless and otherwise we have adequate equity. So in the case of CHF, 97.61.63, they are holding it below that of the initial low. So the sell position, $97.63. With 30 pips hedge order. It will be a buy stop. $97.93. Okay. Now I just taken positions in USD CHF and also position in USD yen and GBP, and I kept the buy limit order in the case of euro. A small dip, we will try to take a buy position in the case of euro around 1.1083. So these are all the four orders I placed based on the conditions, the market reading. So the forecast says, first of all, Swing and slide moves are expected. This is a gross forecast. Then we do the market reading by comparing the current market level with that of the initial lows and the highs set for the day. And here we find that euro is still holding above that of the initial high for more than 30 minutes from start of the session. The session starts by 7:30 GMT. So when they hold above that of the initial high for more than 30 minutes, that means they are likely to take it up. And in the case of GBP, they are holding below that of the, they just made an upward stop and above that of the initial high and holding above around that of the initial high. And they wanted to just make a brief reaction to that of CPI, which is going to be released in another 15 minutes. And afterwards, they are expected to make a slide. So I take a sell position in the case of GBP because they made the upward stop and come down. So they are likely to briefly make an upward stop if needed. Otherwise, they will straight away make a slide. So to have a position, I just taken a sell position around 55.90. Then in the case of yen, they are holding below that of 124.38 for more than 30 minutes. So they are likely to come down as a technical trade. Then in the case of CHF also, 97.80 is the initial low. They are holding below that. They are likely to come down. Then these are all the four currencies I am noting down. So now we will see how exactly we track the market. So we note down the derived forecast as an outline for us. Then subsequently we do the market reading. Then depending upon the market reading, how they are placed, whether the market is above the initial high or below the initial low, which are set around 3:30 GMT. And then what we do is use a trading strategy, that is keep 30 pips hedge order to limit the risk. So whether we take a sell or a buy position, we always keep 30 pips hedge order straight away. If it is a limit order also, we keep the hedge order, because if the limit is filled, only then it can fill the hedge. And some people are of the opinion, only when the limit is filled, then later on we can keep the hedge order. It is not like that. If they don't fill your limit, they will not come up to that of the hedge order. So there is no risk involved in keeping the hedge order. So we have to logically think, only when they pass through that of the limit order, what you have placed, then from there they can go high and fill your hedge order. If they are not gone up to that of the limit order, where is the question of going up to fill your hedge without giving a fill for your limit order? So that we need to understand. Then we use the 30 pips hedge order to limit the risk. Always we take only 30 pips risk at a given time. So whether you take a sell position or a buy position, we only take chance for 30 pips. And if you are using the hedge, what are the advantages? So we note down from that of the live market put page the initial lows and the highs, and then we try to place I just kept the orders so that I can spend the time in explaining to you. Meanwhile, you'll be able to watch what happens to that of the market after the data release, so that what I explained to you should come through. That is why I've given it beforehand. Then these are all the session timings. I explained it. Okay, what they do is the type of moves they are doing it in the market. Stop it is a move which they do during start or the early or the late sessions, and they just go about 20 to 25 pips above that of the initial high, and in less than 30 minutes, they reverse it. That is stop point. So they pretend as if it is going to rise, but they drop it quickly. After hitting all the stops, they come down. Why they hit all the stops? Because they would have noticed that a lot of people have got sell position with the stop. So they hit the stops of the sell position holders. So their positions are closed, and the stops, they take the sell positions. So the players are privileged to take the highest level sell by hitting the stops. And the highest level buys happen to that of the traders. Then afterwards, they drop the market using the data release. So what we do as a smart trader, when they make such upward stop, we can take a sell by keeping the sell limit order instead of just take the position at the market. So that is why, as an example, in the case of euro, I just kept a buy limit order 5 pips below that of the current level, around 1.1083, because 1.1082 is the initial high. They are holding above it. Then false move is the one they come up to the high and reverse the market. In the case of GBP, they are trying to do it. They pretend as if they are going to breach, and they are just making a dip. Pretend as if they are going to breach and just making a dip. The false move, they do it before the data release and also during the gap time, which is also a move which happens in less than 30 minutes. So you can understand that if 8:30 is the data release time, probably by 8:15, 8:20, they start that and quickly make a false move and just create the fear for the traders. So those who are taking the sell position in GBP, when they make a small firm up, will go on do the short covering, and later on they drop the market. So this is what they do every time. And in spite of that, the traders continue to lose some money. That means they are not learned out of their experience. They learned out of experience, but they simply say that what they have done is right, the market has gone wrong. So when they put the blame on others, they fail to understand what are the mistakes they have committed. That's what happens. Now, more than 30 minutes, up to 2 hours, they make the moves. They are called extended move. That is, they breach the high and stay above that of the high for more than 30 minutes. Up to 2 hours, they will hold above that of the initial high. Only then they will start making the slide. And at that time, they could breach every 30 minutes the high what they have set and go higher. And finally, after the extended move, they will make a drop. So this extended move, they make it as a quick move in order to mainly offload their buy positions. So if they have the buy positions, they will quickly make a rise, hold for 2 hours, and just induce the traders to buy. And the traders will think that euro is not going to drop, it might go higher. So they will immediately do the short covering. And later on, you find they just make the slow slide from that of the market. Now, slowly, they are dipping euro, they are firming up GBP. That is what they want to do. Now it is 8:24 GMT. Exactly 8:30 GMT, you just see how exactly the market behaves for the data release. So I do not know anything about CPI, but I can tell you that they want to drop GBP after CPI, because they are making a false upward quick move. This is the only indication we can find out. With the help of that, we'll be able to easily take positions in the market. Then you come across another type of move, namely the intentional move. This happens for more than 2 sessions, more than 2 hours, then up to that of 2 sessions and the start of the 3rd session. And that is a slow move. And it is a slow move, and every 30 minutes they will breach the new low and come down. Or if it is an upward move, every 30 minutes they will breach the high and go above. So that is how they will make the move during that of the intentional move. So the intentional move will always be slow move. whereas the extended move will be a quick move. They will jump 10, 20 pips, they will quickly make a jump. And that will give fear to that of the traders. And also you find some green candle formation on the upside. So immediately, which gives the trigger for the traders, okay, there are green candle formations, so immediately we should buy, and 3 successive green formation. So we buy, and later on you find that the players make the opposite move. So this is what happens. So then traders say that no, every technical analysis is a lagging indicator. It is not giving the true picture. It has given the buy signal, but I want to confirm it again before going to that of the new trade, because they slowly lose the confidence in any of those type of analysis. Why? Because the players know very well how the traders are using the technical analysis, and they just see that traders get adequate technical analysis free of cost, so that the traders could find that technical analysis might work. When it is available free, why not we take it? Then once they follow it, later on they find that the players make a different type of move and track them. Then immediately, if you ask the expert, he will say, that is what I was telling you, that keep the stop. So the trader cannot do anything. So ultimately, you come across a situation wherein the trader is fixed. Either you take it or quit. That's all. There is no solution given to that of the trader who is distressed. When he is losing money in the market, he wants somebody to hold the hand and give him the appropriate method by which he can earn money from that other market. But initially, to attract the traders, the bonuses will be given. All nice words will be spoken to the traders to open a trading account. All free analysis will be given. But afterwards, when the trader finds that he is losing the money, there won't be any response from that of the platform provider or any technical analyst. This is what happened day in and day out, which has resulted in the adequate reduction in the volume in the market. That is why you find market is waiting for the data release. Now we get the euro getting filled. So the players, when they simply trap the traders all along, then the traders find that it is not the suitable thing for us to make use of. Because when the traders find that every next person is losing money in the market, then the trader also it is thinks that it is better to hold that whatever the money left rather than again risking it. Because when they think it is gamble, then they hesitate taking positions. But when they think that market can be read technically, then they come to that other market. But when they find later on, it becomes a gamble, because when you say euro is going to go up, it comes down. When euro is going to come down, it goes up. So they are not in a position to understand. It is a question of tossing the coin. So they lose the confidence in technical analysis, fundamental analysis. And finally, they think that it is not the right place to make money, because whatever the hard-earned money I made, I tend to lose. So when the traders lose their confidence, you find the market volume comes down. Again, you find so much of email marketing and other things happen, and they try to attract new traders to enter into the market in order to grab their money also. So ultimately, if the trader wants to consistently make money from that other market, we need to understand the other side of the hedge. Who are the people who are trading against us? And what are their intentions? Once you understand their intentions, you find that now they gained the level exactly by 8:30 GMT. Now, euro, they are given the fill. GBP, I think they are hedged. Yes, it has become a position. Now GBP 56, 38, 40, 41, 56, 20 is my hedge order. So it is hedged. Okay. Now the hedging is making profit. See, there comes the importance of the trading strategy. The hedging is making profit. So what I do is I'll keep stop at entry. That is 1.5620. So now they formed the high 56.42. If they stop cutting the new high for 10 minutes to 30 minutes, that means it's an extended upward move before making a slide. Because they gained the level in the case of GBP and dropped the level in the case of Euro as a contrarian move. So this is what we need to understand. So yen, they are holding it as such. And in the case of CHF, okay, it is just making about 3-4 pips. So nothing spectacular happened except in GBP where they hedged me, and the hedging is making profit. So I kept entry. So once the hedging is making profit for more than 30 minutes, then got a chance to reverse the trade also. You can simply close the sell and maximize the profit on the buy side. If they continue to cut the high every 30 minutes, that is the intentional move on the upside. Whereas they formed the new high as an extended move, stop cutting the new high for 30 minutes. That means they made a quick extended move as a knee-jerk reaction for the data, and subsequently they wanted to make a slide, opposite move. So that is what we understand. So 56.42 is the level they are set. So in another 30 is the data release time. You will wait up to 40, 8:40 GMT for 30 minutes. Now they cut the high by 2 pips. So 56.44 is the new high. So from here, we wait for 10 minutes. So up to 43 GMT. So this is how we can just wait calmly without looking whether the candle formation or anything. Understand what sort of moves they are doing it in the market. And then we find that whichever way they make the moves in the market, we will be able to make profit and make net profit from that of the trade. That's what I wanted to show you. So that is why I committed the positions before and then show you how exactly the hedging is to be used. So now it is 8:34 GMT, another 6 minutes, 7, 8 minutes to go. They don't breach. Then we'll close the buy position around that of the high, 56.44, and keep another hedge order 30 pips above that of the market. Now they made 46. So now you can understand they are cutting it, but they just cut the high pip by pip, 47. So that now you are able to see in live condition how they are handling the high. So that we'll be able to read whether it is an intentional move or an extended move. Now, you might be thinking, okay, you wanted to reverse the trade. I'm just giving it for the theoretical purpose. Okay, you wanted to give a call that why not we close the sell and then maximize the profit on the buy side. If it is an intentional move, if they continue to cut the new high every 30 minutes, what happens? Now we are taking a sell around 55.90, which is making about 60 pips loss. Then you will think, do you accept 60 pips loss? No. It is again only 30 pips loss because we have 56.20, which is making 30 pips profit. So we can close the sell position Even when they go to 57, still we will be just making a loss of 30 pips because the other buy position will be making profit 30 pips less of the actual profit it is supposed to make. So if the market, after closing the sell, the market makes another 30 pips upward move, then we'll be in the money. That's what we need to understand. So whichever way they make the move, we'll be able to book profit, net profit. That happens only when you focus on the trading strategy. They again cut it by 1 pip. So 36, it is 8:36. So you just watch the time, how exactly they are doing it. They are coming down slowly, and USDN, they are not making any big move. And CHF also not a big move. Only GBP they are making the move. So fortunately, we have got a situation wherein that I will be able to explain in live condition how the hedging has to be handled. 56, 52. We are watching the time simultaneously. So 10 minutes, I was telling you, 4:30, that is 8:30 GMT, the data was out. Now 7 minutes passed the data release, and they came up to the top 56, 52. Stop cutting the high. Let us see whether they stop cutting the high for 10 minutes. Up to 8:40 GMT. Then we will close the buy position with a profit and keep 30 pips above another hedge order. Then when they start making the slide, we'll be in a position to book profit. So now how exactly cleverly they just made the contrarian move. If you look into that on the quote page, that euro is showing negative net change, GBP is showing positive net change, by which we are able to push down euro GBP from 71 area to 70, 72 because they made GBP stronger. And at that time, in sentiment, in line with the market sentiment, euro is expected to go up, whereas they are pushing it down. Similarly, CHF is expected to go up, they are not rising it. Then USD yen is expected to come down because when GBP is making the USD weakening sentiment. Whereas if we look into the Australian dollar and Canadian dollar, they are still making the USD gaining moves because Canadian dollar is weaker by showing positive net change. USD CAD is a denominator here. So when it is in positive net change, that means the lower currency is weaker. And here, US dollar is in the denominator, Australian dollar is in the numerator. So this currency, you find that it is weaker. The numerator is weaker when it is showing a negative net change. So you find that they are making mixed moves in the market. They made further cut to 56, 57. So for 8:39 GMT, we'll calmly wait and capture the profit. And I'll show you at the end of the European session, when I come for the US session, tracking the forex market together webinar, how exactly this position is closed with a net profit. So after waiting for 10 minutes, they don't cut the high. So this time onwards, we have to wait for 10 minutes so that I can book profit on the buy side and keep another hedge order 30 pips above that of the market. Once they start coming down, then I will try to move it. So they will slowly reverse because they are doing the contrarian move in the market. And later on, we will see how exactly the trades have gone through. So 56, 57 is the current level. So they are trying to buy around 56, 57. 59 is taken. So it is 4:40, 10 minutes past the data release. So they are all quick moves they are doing it, if you are able to see that. So when they make such quick moves, the big candle formation is seen because suddenly the candle jumps. When they make the candle for 3 pips, 2 pips, and suddenly they make candle for 5 pips, the candle will look bigger. But if you look into that of the live market code page, you can easily understand they just gained only 3 pips, 7 pips like that. So from 56.57, they gained about 4 pips to 56.61. They stopped dropping, So GBP is the currency. They are trying to use it to create the market sentiment. Still Australian dollar is in the negative condition. Okay. Now in the meantime, I'll explain to you the slides. So we've tried to find out how exactly they are making the extended move for 30 minutes. So first of all, we have watched it for 10 minutes now. After 30 minutes, if they stop cutting the new high, then we'll straight away take that. This is what the trading strategy. So what we do is we keep the hedge order to limit the risk. And once the hedge is filled and the hedging is not making profit for 10 minutes to 30 minutes, we close the hedge and keep another hedge order, understanding that they filled the hedge during that of the stop and move. But if the hedge is filled and then the hedge is making profit, that means they made an extended move for 2 hours, and during that time it got filled. That is why the hedge is making profit. Or it might be an intentional move also, provided they cut the new high every 10 minutes, 30 minutes like that. Then we will simply reverse the trade and earn money on the upside. That is on the buy side. If they just make only extended move and then reverse the market, we will book profit on the buy side as well as book profit on the sell side. So we are prepared to book profit on either way moves of the market. So there is no question of market fear. Then after the position start making profit, we keep stop at entry, and then we keep about 45 pips or 75 pips limit order and use your 25 pips trailing stop in the profit making position, so that the market might hit our trailing stop or the limit and close our position with the definite profit. So this way we try to protect our profit and also maximize the profit. So when it is hedged, we wait for 10 to 30 minutes and watch what happens to the top of the hedge. They cut the high again, 56.65. So they are quickly making the upward stop end, and that shows all quick moves or false moves in the market. So they have to stop cutting the new high, 68. See how quickly they are making the move, and then we understand why they are doing like that. So the focus says that they are expected to make the swing slide. At the moment, they are gaining the levels. Let us see by end of this session whether the forecast has come true, and also our market reading has come true, that we have taken a buy position in the case of euro and sell position in the case of GBP, and also sell position in the case of USDN and USD These are all the positions. Euro, they are not coming down much, but they made it as a position for us. Okay, if there are questions, then you can ask the questions. I'll answer to those questions. Meanwhile, we'll also follow the market and try to understand what they try to do. Now 69 is the high. It is 15 minutes past the data release. Okay, Tico has got a question. When you use charts, oscillators, candle patterns, etc., it is hard to follow only numbers without charts. Okay, I used to tell in the webinars that when we were doing our preliminary schooling, we were shown with the figures. No, elephant means an elephant picture. Lion means a lion picture. And any of the table, chair, etc., those pictures are given for us to just to visualize and get that impression about it. But after a certain age, do you expect those pictures for you to understand? That's what I don't want to talk more than that. Then FX trade. You close the original position when GBP USD is hedged. Do you close the original position? No, I don't close the original position. The original sell position remains as such. I only hedged by taking another buy position, and that buy position is making profit. 56.20 is the buy level. And I kept stop at entry, which was not filled, and they are gone above. They are cutting the new high every 2 minutes, 3 minutes. And afterwards, after 30 minutes, that is 8:30 is the data release time. So by 9 GMT, they will stop cutting the new high and hold it. That indicates that it was only an extended move on the upside for the data release. They have done it in order to handle Euro GBP cross, and later on they will try to handle it differently, because we know very well that they create the market sentiment and act against the traders who have taken the positions. So anybody who has taken the sell position will become afraid when they see that they are cutting the new high and the green candle formation, etc. They will immediately go and close their sell positions or stop it out. This is what they want. That is why they make such quick moves. There is a hurry to make such quick moves in the market. It is nothing but to trigger our fear, market fear. In FX trade, I explained it. So I don't close the original position. I'll try to hold the sell as well as the buy and book profit on the buy side, take another sell and close both the sells below their average. That is either way trading. Or we can simply keep another hedge order for the sell until they come down to this sell level. I will trail the hedge order and book profit on the sell side also. You know that market continues to make up and down moves. No, it is not one-sided rise all along for 365 days. They make upward move and then downward move. Especially Euro and GBP, they make oscillations of up and down moves using different triggers. Other currencies, they make one-sided moves. So if you are trapped on the wrong side, then it might take several days for you to get out of it. Whereas Euro and GBP, whether you have a buy position or a sell position, you will be able to book profit if you wait. But if you wait without the hedge order or the stop, what happens when they gain about 100, 150 pips, then your margin will be grabbed by that of the position which is making loss. And that may give the fear for you. So if you use the hedge, then it only blocks 30 pips, nothing more than that. Let the market go anywhere. Then later on, once they stop cutting the new high for 30 minutes, then we will try to take profit on this buy side. Then suppose we have booked about 50 pips profit on the buy side. Then I don't mind closing the sell position with 30 pips loss or 20 pips loss, because still I'll have a net profit of 30 pips. Or if I try to close it with stop at entry, then I'll make clear 50 pips on the buy side. Otherwise, if I make profit on the sell side as well, I will have double profit, both on the buy side as well as the sell side. Because in the market, there are buyers and there are sellers. The buyers might be happy on certain occasions. The sellers might be happy on certain other occasions. Those who use the hedge, they become always happy both on the buy side as well as the sell side, provided they know how to handle it. They think that they are struck with a buy and the sell position, and the sell is making loss and the buy is making profit. That means their perception is wrong. If they think that it is a great opportunity, okay, on the buy side, when they are rising, I'll book profit. Later on, they will make a drop on the sell side, I'll book profit. Then you know very well market means up and down moves. It is not always a continuous up or a continuous down move. They rise today, tomorrow they drop. If you wait for a day, you will be able to book profit. So that sort of understanding will come. Then small traders will not lose money. The players cannot use the same old trick of creating the market fear for the traders. But if you try to use the candlestick, and what happens when they are consolidating 10, 15 pips, the candle formation is seen in 20 pips, then obviously the screen, you'll come across that big candles showing about 5 pips, 2 pips, 3 pips like that. Then suddenly when they gain about 40 pips, you'll find one big green candle. Actually, it is nothing but the magnification. So then the chart becomes very big, and automatically you find all relative candles become small in order to accommodate within the window, and the single candle becomes spike candle become big. Immediately the trader gets the fear. Actually, they would have gained about 35 pips, but it will appear as if it has gone to heaven. Then immediately anybody who has gone short will go for a short covering, thinking that it is a wrong trade. So every time you come across the traders repent like that, what is the use of repenting? Because you come to the market to make money. And in that, you find that I committed a mistake, so I lost it. I committed a mistake, I lost it. How many times you can say that? So you have to understand something basically wrong with us. So we have to change our approach to the market. Understand who is behind the market and how they are going to play in the market. We should be able to read their intention. They cannot keep it as a closed card. They have to expose it in the market. If they want to rise GBP, they have to expose it. If they want to drop euro, they have to expose it. And if they are making a quick rise, then we need to read the intention. They want to make a quick rise to offload the position. They want a quick drop to buy back all the positions. That's what day in and day out they are doing it. But when it comes to the lower level, immediately we think that it is very risky to do the bottom fishing. When it goes higher and sell, then it has breached all the resistance and gone above. So it is not ideal to take sell position. That is what we think. So we should get rid of such market fear. Only then we will be able to successfully earn money from the other market. Then, is our USD do not move for the entire European session? Do you close the position after this session? No, I can hold it for your session and close it by end of the day. Then would the rise in GBP be the start of the level change? No, they have to make an extended downward stop and before making a big rise, as I explained yesterday. That extended stoppant is the indication for the shift in trading zone. Otherwise, they are only making the swings in the market, wide range swings. When will buy hedge position close? Yeah, once I close the sell position or simply keep stop at entry, I don't bother where they are taking it. Let them take it to 1.57, 1.58. Okay, let them come down and close my 1.5620 with stop at entry. I will continue the trade after keeping another hedge order to limit the risk 30 pips above. Then let them come down. I'll book profit on the sell side. So we have got ample possibilities when the position is hedged. We think that you are struck, you are struck. It is something like you got into the car and you got into a traffic jam. Then immediately you think that you are struck. Then you jump out of the car. But you know very well, all the people in front of you and behind, they want to reach home. They will also find the possibility of reaching home. And how the policeman is there to regulate the traffic, and people might help such policemen to do that. Ultimately, everybody will be able to reach the destination. If you lose your patience and shout and come out of the car and say, what a traffic jam and things like that, that means you don't have patience. So this is what happens in the market. I always say that the market rewards patience, not impulsiveness. So the buy hedge position, after the high is being stopped, they stop cutting the high for more than 30 minutes. I will try to trail the hedge order after booking profit on the buy side and trail the hedge order until they come down and give profit in my sell side. So, Raja, you mean if the market will not come, let us say, back to 1.5620, our buy will open forever? Such a situation will not happen, sir. I will keep the buy position just like that for you, and later on you see how, or you look into that of the market levels. They keep visiting those levels, sir. And if you imagine that they will never come back, that means something wrong. You have not understood the market. It is not the extreme bottom or it is not the extreme top, not visiting it. And even if they don't come to 1.5590, after gaining about 150 pips, they will make a drop of 75 pips before making further rise. What I will do, I will take another sell position and close both the sell position below their average and make net profit. And again turn long and book profit when they rise the market. So if you focus on the trading strategy, you've got innumerable possibilities. Only thing is you have to choose the right trading strategy at the right time so that you'll be able to consistently make money from that of the market without any market fear. Okay. You took position in GBP, but the spread is not at 40 pips or more. Yes, I took the sell position in order to show you how exactly the hedging has to be handled. That is why. And also, I was telling you that after the data release, they are expected to make their slide. But what they have done, 55.90, 92 they have been holding. From there, they gained about 80 pips, 79, 80 pips. See how quickly from 55 to 72 they gained the level, and now they are not cutting 56, 72. Nowadays, 8:58 GMT, 2 minutes to 9 GMT. Just watch. If they stop cutting it, I will book profit here around 56.70. Keep 30 pips hedge order and trail the hedge order when they slowly come down. Then you see what happens to the other market. And I will come back by 14 GMT and show you the results. Okay, can you explain the difference between the slide and the drop? Slide is about 25 pips or so dip. Then the drop is about 45 to 65 pips. So that is how the pip quantification has to be explained in a qualitative way. That is why I'm using such words in order to bring the difference. So there are no more questions. So 72, it is 459, I mean 859. So they are not cut that. So I will close it at 56.70 before you. Okay. Then I kept another hedge order 30 pips above, which will be new hedge order is a buy stop. Okay. Then I'll come back by 14 GMT and show you what happens to the trades. And also, I will explain to you what happened to the highs and the lows, what they are set during the day from start of the Japanese session, how during that of the European session. Then we will review that during that of the US session and understand how the players are making moves, and which can be easily read with the help of the live market code page rather than any other tool. Then it is easy for us to earn money from that other market, because pip by pip move you'll be able to see that. And only thing is, you should have a little bit of interest in remembering the numbers. Once you remember the numbers, then you find no chart is needed for you to understand the market. With the help of the simple live market code page and the net change and also the time frame. So we have the level as well as the time in order to understand. See, exactly 30 minutes up to 9 GMT, they have been doing all the quick upward move. So which is a clear extended move in the case of GBP for 2 hours. So up to 11 GMT, they will be holding above that of 1.5590 and start coming down later on using some other US data release. So that is what will happen during the day. You can watch, then understand how the market can be tracked. So once you understand the technique of tracking the market, then earning becomes easier. So please track GBP as well as Euro and also other currencies and come back by 14 GMT. Then I will give you the part 2 of the webinar showing the results and also take the positions for the new session. Thank you one and all. Wish you all happy trading.